I think one of the things that is a lesson to me over the last couple of weeks is that it is rarely the things that you anticipate that turn out to bite you in the you-know-where. I don't think at the beginning of this year anyone expected that the coronavirus was going to shave the stock market the way it has. And then when you add to that, I don't think many people expected a crude oil crash, the likes of which we got yesterday.
No, we had a trading sell signal from our short-term model in mid-January. We wrote about it and said, sell all your trading positions, raise some cash in investment accounts. But quite frankly, I didn't think it would be this deep. At that time, we were only dealing with...
Did you think it would be traceable to coronavirus? Or?
Well, at that time, we were dealing with the virus, and we were dealing with Joe Biden surging in the polls.
No, not Biden. Sanders. Sanders surging in the polls. Right. Okay.
I had no idea that this crude oil crash that came out of the blue, it totally surprised me.
Julian, when did the coronavirus start to show up in your thinking?
So at the end of January, particularly when we saw the public piling into the technology stocks that had exposure to China revenue, we got very cautious. We suggested put options going out to March and April. And frankly, like Jeff, we thought that the coronavirus would be a market negative. We didn't think it would be something that has changed psychology as profoundly as it has these last 3 weeks.
So how long is it going to take to shake off the effects of this sell-off?
Bottoms tend to be a process, and they are a function of time and price. It's like a heart attack patient doesn't get up off the gurney and run the 100-yard dash. It convalesces, and the markets had a heart attack. And so, I don't trust the first rally. I think we're going through a bottoming process. I think the lows are probably in, but I don't think we're going to get right up and run the 100-yard dash here either.
But fundamentally, Jeff, you say we can trust the bounce. We're close to the bottom here. Whereas, Julian, you seem to say no, you don't think we're at all there yet.
Well, what's interesting is your folks asked me that this morning when we were up 90 points in the S&P 500, and we responded no, and we dropped 4% in literally a straight line. This is part of a process. From our point of view, if you look back to February 28th, that down day, that Friday, was sort of the shock day. Yesterday, in our view, was, the real outright fear day because, there was headlines dominating. We'd expect sort of a retesting day perhaps in the next week or so as we digest news of fiscal stimulus and then the Fed.
How much damage has been done to the psychology of what's been a dozen-year-long bull market? Is it over? Is it over?
No.
No. This is a correction, not the end of a bull market.
Secular bull markets, and there aren't many of us left around that have seen it. 1949 to 66, were there 30% declines? Yeah. 1982 to 2000, were there big declines in 87? Yeah. But the bull market went on for another 13 years. Secular bull markets last 15 to 20 years and aren't interrupted by a 20 or 30% drawdown. And again, there's not many of us left around that have seen. I mean, I've been looking at markets for 56 years with my dad, and I've been in the business 50 years. So,
you look pretty good.
It's the makeup. It's the makeup.
It's the makeup. It's the makeup. What do you say? Is the bull market over or not?
So from our point of view, part of the reason that stocks have sold off to this extent and that there's this buying opportunity is that you actually do have to allow for a probability that it ended. We'd put it at 30%. But the reason we think that 70% is that the market has not topped on a sort of multi-year basis is because every bull market has a very large level of public participation at the end that takes things to extremes. And we just don't think what we saw in January and February was that type of extreme. And with interest rates below 1%, we think at some point all the money that's been going into money market funds and fixed income over the last 5 to 10 years is going to start moving towards stocks.
All right, gentlemen, thank you very much. Julian and Jeff, good to see you.